There's a new geopolitical shock this morning. South Korea's president declared martial law overnight, accusing opposition parties of plotting with North Korea. The Korean won slumped. Australian GDP figures today are set to show a re-acceleration of growth. That's coming up in our 5 Things in 5 Minutes. And then in part 2 of a bonus deep dive interview on Asian currencies across next year, ANZ's head of Asia Research, Koon Goh, looks at which export-dependent economies are most at risk from trade disruptions.
And therefore, we feel that the Korean won and the Taiwan dollar in particular could bear the brunt of any severe downturn in exports.
But first, in 5 and 5 with ANZ, the big news on global markets and in geopolitics this morning is the shock declaration of martial law overnight on live television by South Korea's President Yoon Suk Yeol. He declared martial law in South Korea for the first time since 1980, saying the opposition parties that currently control parliament were conspiring with North Korea to destroy the state. The leader of the opposition, Lee Jae-myung, called on South Korean citizens to gather at the parliament buildings and warned the return of martial law could collapse the economy. The South Korean won slumped 2.6% on the news to a new 2-year low, although it's retraced some of those losses after the South Korean Central Bank said it was considering intervening. South Korean stocks listed in the US fell as much as 6%. Here's ANZ economist Bansi Madhavani speaking overnight from London a couple of hours after the declaration.
The extreme nature of the event means that the moves should be countered by Bank of Korea intervention. In general, the crisis can trigger safe haven demand for US treasuries, but the fact is also that the crisis is domestic in nature, and we expect that it should not have any major spillover impact.
She was speaking as the South Korean parliament also voted against the declaration of martial law. The Aussie dollar was virtually unchanged at 4 a.m. Sydney-Melbourne time from yesterday morning at 64.73 US cents, having dipped on the initial reports from Seoul at midnight. The Kiwi dollar was down 0.21% at 58.74 US cents. Number 2. The final partial indicators for Australia's Q3 GDP tugged in different directions, says ANZ senior economist Adelaide Timbrell. On the downside was net exports, while public demand was higher than expected.
Net exports contributed just 0.1 percentage points to Q3 GDP growth, less than expected, partly due to a deterioration in terms of trade of 2.5%. Public final demand, though, was stronger than expected, contributing 0.7 percentage points to GDP growth in the quarter, mainly due to a jump in government investment.
Number 3. Adelaide says the final indicators haven't changed ANZ researchers' expectations for the data today, which should show a re-acceleration of growth.
Our forecast for GDP growth is still 0.5% for Q3, with a little bit of upside risk. Household incomes will be supported by real wage growth in the quarter, as well as the tax cuts from July, and strong public sector momentum will also drive that growth upwards.
Number 4. Those July tax cuts in Australia are also contributing to higher ANZ Roy Morgan consumer confidence. It rose 2.7 points last week to 88.4. ANZ economist Sophia Angala says that's its highest reading since May 2022.
What drove that jump in consumer confidence last week was a rise in the time to buy a major household item sub-index, which ticked up 7.5 points as those Black Friday related sales continued. So this 7.5 point jump was the largest weekly rise in the sub-index since the Black Friday sales of 2023, and this is now at its highest level since May 2022. There was also a rise in confidence across most of the sub-indices, where the only decline was seen in households' confidence in the economic outlook over the next year.
Number 5. South Korea's inflation ticked up to 1.5% in the year to November, although that was below expectations for 1.7%, as food price growth came in weaker than expected. Now, speaking before the declaration of martial law, ANZ economist Crystal Tan says a weakening currency may put upward pressure on inflation.
Inflation data showed that price pressures are contained, and then you have monetary policy settings that are still restrictive. You have growth concerns coming back to the fore. So further rate cuts are a matter of time. The Bank of Korea has already cut its policy rate twice. We see scope for another 2 25 basis point cuts in the first half of 2025.
Crystal Tan there. Now, in part 2 of a deep dive interview, ANZ's head of Asia Research, Koon Goh, looks at which Asian currencies might be most at risk from trade disruptions through 2025.
Looking around the region, we expect the more export-dependent economies to be impacted most from any disruptions to trade, and therefore we feel that the Korean won and the Taiwan dollar in particular could bear the brunt of any severe downturn in exports. The Singapore dollar itself will not be immune as well. The Singapore dollar is very strongly correlated to movements in the US dollar, and with the US dollar staying strong, especially if the Fed were not to cut rates as much as previously thought, we could start to see the Singapore dollar also weaken. On the other side of the coin, the two currencies we feel would probably hold up much better in an uncertain trade environment is the Indian rupee and the Indonesian rupiah. That's because both those economies are less dependent on exports for driving growth. Domestic demand is more important for both economies, and for that reason, that's why I think they will probably be in a better position to outperform some of the other more trade-dependent regional currencies.
How about Vietnam? I was fascinated to see on your note that the United States has a trade deficit with Vietnam at $120 billion US, and now the third largest after China and Mexico. Extraordinary, really, if you consider the history of the United States' relationship with Vietnam. So what do you think is the prospects there? Because Vietnam's been one of the beneficiaries of the friend shoring, I suppose you'd call it, some of the China supply chain through Vietnam into the United States.
Yes, Vietnam has been definitely one of the biggest beneficiaries of the whole China Plus One diversification strategy, to the extent that China now runs the third largest trade surplus against the US after China and Mexico. And therefore, that put Vietnam very vulnerable should the incoming Trump administration decide to impose some kind of trade measure against Chinese imports. If they do that, then Vietnam's economy would be very vulnerable given its reliance on exporting to the US. That would definitely put a lot of pressure on the Vietnamese dong and might force the dong to weaken quite significantly in order to counteract or offset any potential tariff action and any potential hit to their export growth.
Just looking at the various currency pairs within Asia, particularly between China and Indonesia, how much of a movement could we see there?
The rupiah is definitely a currency that we think can probably hold up much better in the face of an increasingly hostile trade environment, whereas the Chinese yuan we expect to play a huge important shock absorber role to any additional tariffs that the US will impose. Therefore, we see scope for the Indonesian rupiah to outperform the Chinese yuan, and I wouldn't be surprised if the movement, relatively speaking, could be as large as what happened during the first trade war, where the yuan weakened by around 10% against the Indonesian rupiah during that period.
And just looking at the relationship between Asia, ex-China, and Europe, what is the currency pair to keep an eye on there?
Yeah, so one of the currency pairs highlighted is the euro versus the Korean won. The Eurozone economy is struggling, and we now expect the ECB to be more aggressive in cutting interest rates, taking their policy rates to 1.5% next year. On top of that, I think there's a potential for the incoming Trump administration to perhaps focus some of their trade policies against Europe as well, which could weigh further on the single currency. Conversely, while we do see the Korean won weakening, we still feel that there's potential for the won to outperform the euro. And while the Bank of Korea has cut rates twice in a row now, we see a limit to how much more the Bank of Korea will cut next year, given their concerns around household debt and strong property prices in Korea. So the yield differential between the Eurozone and Korea will move increasingly in favor of the Korean won.
Koon Goh there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, December the 4th. Catch you tomorrow with details from those Australian Q3 GDP figures and what it could mean for the Reserve Bank of Australia's rate cut starting date. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.